Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to be talking about an exciting sector, a company which is going to be bringing its IPO, going to get listed soon on the bourses. It's the hospitality sector, which has done really well over the last couple of quarters. The economy since the COVID, after some time of stability, we actually then started seeing some very strong numbers from the existing listed companies in the hospitality sector, and this company perhaps is going to bring some more excitement for the investors. Let me now introduce the company, Samhi Hotels, and also now welcome the management, Mr. Ashish Jakhanwala, the chairman, managing director, and the chief executive officer of the company. And accompanying him is Mr. Gyandas, executive vice president and head of investments. Gentlemen, welcome to the show.
Thank you so much. Thank you so much.
Let's start with the most basic stuff. That's my favorite question for any company which is bringing IPO. Ashishji, let's start first with you. Help us understand the business model of the company, because an hospitality company either could be working on a very asset light model, could be working on an asset heavy model, could be doing only management contracts, or could be doing a hybrid sort of model. What is the model which Sami Hotels follows?
So thank you so much. Just quick introduction. Samhi is the third largest owner of hotel rooms in India. We own about 4,800 rooms across 31 hotels. Our principal business model is ownership and asset management. So we own the asset and we would always have a brand partner to run it for us. So that's the brand model we follow. But having said that, what we've really used historically is a strategy of acquiring underperforming, undermanaged hotels and creating an operational turnaround, through a programmatic approach, change the product, change the brand, good quality asset management. So that's in summary is how I define Samhi.
Right. And when we actually look at Sammy, how do we sort of visualize it? Like which geographies Sammy basically currently is visible or stronger or has the maximum presence?
I'll take that. So if you look at it, as Ashish said, we're the third largest. We're present across 13 cities in the country, about 31 hotels with 4,800 keys. Primarily, we are a business hotel other than one hotel which is located in Goa. We are all in gateway cities. Our presence is in Bangalore, Hyderabad, Chennai, Pune, Delhi, NCR, Ahmedabad. So these are the primary gateway cities that we focus on. Our focus will continue to be on the business segment, and we are also present across different segments, starting from a low level of mid-scale, upper mid-scale, and upscale hotels. So these are the kind of a broad spectrum of our portfolio.
And largely everything in India?
Sorry?
All hotels are in India?
Absolutely.
Yes, all India.
We are an India-focused business. We think that the growth of Indian economy, the growth of the office sector in India, the growth of the aviation market in India, I think makes it one of the most compelling markets to be in, and I think that's what we want to focus on.
Okay, sir. And from the perspective of the keys or the properties, as we know, basically sometimes we give these examples, but all these have a similar sort of analogy. Whether it's banks which are opening branches, whether it's hospitals which are opening new hospitals, or whether it is hotel which actually is opening a hotel company which is opening a new hotel, there is one thing common in every one of them, which is the gestation period to achieve a maturity stage of income. So in terms of all your properties right now, how many are already in mature stage and how many right now are in the growth phase?
So we have, as I mentioned earlier, we have 4,800 rooms operating today. Of these 4,800 rooms, circa 3,900 rooms I would call are in a stable state. There are about 900 rooms that are due for renovation and rebranding. They are currently operating, but they will undergo a renovation and rebranding. And our past experience has been that as you take a hotel asset through a renovation and rebranding, you would see a material impact on the performance of these hotels. So that's how we classify our 4,800 room portfolio. About 3,900 rooms is stable, and about 900 rooms or 920 rooms is due for renovation and rebranding.
So when you actually do renovation and rebranding, usually what is sort of period towards the stable stage, like 18 months, 20, 24 months? Like what is that normal period?
So we have seen that the time taken to stabilize is also dependent on the overall market cycle. So in weaker cycles, we have seen hotels take as long as 2.5 odd years to stabilize. Whereas in stronger market cycles like we are witnessing right now, we've seen hotels stabilize within a period of 2 odd quarters, really, right? And I
Oh
think
wow.
that's the advantage of a renovation or a acquisition turnaround strategy vis-a-vis a development strategy. Because in a development, the development cycle is 3 to 5 years. You cannot beat that, really, and then you take additional few quarters to stabilize the hotel. In an acquisition and turnaround, you actually buy an existing operating hotel, you change the product, you bring a strong brand back onto that hotel, and therefore once you relaunch it in a strong market cycle, anywhere between 2 to 3 quarters, you would start seeing that hotel touching a reasonable level
Agree.
of performance.
Yeah.
Right. And Mr. Gandhar, coming to you on these 900 keys, I'm slightly curious after the statement from Ashish ji about a stronger cycle, because this is actually a technically a stronger upcycle. These 900 keys are in which part of geography, which part of India?
So it's across different hotels. If you look at it, one of the large hotels that we look at is Hyatt Regency Pune, which is a 300 key hotel based out of Pune. We have two hotels in Delhi NCR, which have to go through it. One from Caspia to Fairfield. One is Caspia Pro to Holiday Inn Express. And also there is another hotel that we recently acquired, also based out of Pune, which is a 4 points will be also renovated to Courtyard. To an upscale segment onto it. So these are the spread across different hotels, combining of about 900 keys, roughly about 19% of our portfolio, which will go through that renovation.
Sure, interesting. Let me also ask you regarding the properties. What is the kind of benchmark internally you have for acquiring any new property? Like, is it more about the valuation or particular number of keys? Because sometimes acquirers they say that we only want to acquire keys or hotels which are more than 100 keys or less than 300 keys. Like, what are those different types of metrics which SAMI actually really evaluates before entering a region or before acquiring a hotel?
So I think first and foremost is very strong and objective data points on demand. We typically don't like to speculate on demand. We don't want to go into markets where the demand is not existing as of the date, right? And that kind of makes us focus on the gateway cities, a term we'll probably repeat very often. So that's the first. The second would be effectively the opportunity that we see in terms of operational turnaround, right? So we clearly need to see some sort of levers where the performance of the hotel can be impacted through a renovation, rebranding, or asset management that we undertake. And while we're doing all of this, one of the financial disciplines we need to follow is that we need to acquire the asset, including the cost we spend on that post acquisition, at a discount to replacement cost, right? And that's really, really important in a business like ours, because replacement cost effectively is the cost that future competition has to pay. So if we have hotels in Bangalore that we have acquired at below replacement cost, one of the important factors for future will be how much new supply is coming, right? And new supply is going to impact the performance of my hotels, but new supply has to come at replacement cost, right? So long as you're building a business at discount to replacement cost or industry averages, right, which is where we've done reasonably well, I think those are the few parameters which we follow. But other than that, honestly, there's a lot more there's a lot more analysis one needs to do, not just for the short term, but for a really long term. So you need to look at the fundamentals and not just the technical upswings. So one thing I keep correcting, that people are often classifying the current upswing in the hotel industry to be just a bit temperamental, if I may use the word. But I actually feel that the upswing that you're seeing in the sector is more fundamental. You're seeing demand having grown anywhere between 8 to 12% CAGR over the last several years. The new supply is barely between 2 to 6% CAGR. So when you have demand growing at 8 to 12 and supply at 2 to 6, I think this fundamentally a very strong sector to operate a business in. And I think that's something that we will test at each micro market level. So while it's easy to say this at an all India level, but the same test needs to be applied to each micro market level. So those are some of the parameters we typically evaluate before making an investment decision.
Right. Sounds good. Um, Mr. Gandhar, coming back to you, from the perspective of revenue generation right now, what are the sort of different types of revenues we are generating from the hotels?
So as I said, that we are primarily a business focused hotels. Our primary source remains and continues will be the room segment. However, we do have about approximately 25% contribution from F&B, and then circa about another roughly about 5 to 10% from other income. But primarily, it remains to be a room-focused business for us. However, the F&B contribution kind of changes from segment to segment. At a lower segment, which is the mid-scale segment, will be about circa about 5 to 10%. And upscale, it can go as high as 35%. But yes, primarily it is a room-focused business.
To add to
Right.
that, I think one thing which is really important for us is a diversification and balance across price points, and also a reasonable presence across the key gateway cities. So if you see, as of 31st March 2023, about 48%, 47% of our revenues come from upscale hotels, and about 53% comes from the broader mid-scale portfolio. So we have a good balance between upscale hotels and gateway cities and mid-scale hotels. Similarly, if you look at gateway cities, we would see that about 25 odd percent, 26% of our revenue will come from a market like Bangalore, which also happens to be India's largest office market with about 190 million square feet of occupied office space. So our presence of our inventory or our revenue of 25% in Bangalore is not just by default, it's by design, because we were trailing the growth of the office market in that city, right? And following that, you would see about 20% or 19.5% of our revenues come from Hyderabad. And we all know how well Hyderabad has grown over the last several years. And then about 17.5% from Pune, and 10%, 11% from Delhi, and rest is from the rest of the cities. So while Gyana articulated about 75-25 on rooms and food and beverage, but I think I'll also like to highlight the fact that we are well balanced between mid-scale and upscale, and also the fact that our revenue profile is largely following the growth of the office and the airline market in the gateway cities.
Just a very short question, Ashiji. Between upscale and mid-scale, what's the difference in the average room size? Or not room size, I should correct myself. Average number of keys of a property.
Average number of rooms per hotel?
Yes.
So we have 5 upscale hotels, and they will total approximately 1,000 rooms, right?
Rooms average.
Yeah, that's right. So about 1,070 rooms across 5 hotels. Whereas if you look at the mid-scale, the rest of the portfolio, so about 3,700 odd rooms, are spread across the rest of the 26 hotels. So the average size per hotel in the mid-scale tends to be slightly lower, at least in our portfolio. We're not trying to make a commentary on the broader industry, whereas the upscale hotels tend to be slightly larger in a room per hotel basis.
I understood. So the upscale is around 200 or anything plus minus, but mid-scale is somewhere around 120, 150 average. But that also tells me that 100 keys might be something which you definitely require actually for to be there in any property. Perhaps an easy.
Yeah, I think so. You're right. We feel that the economic benefit of 100 plus is more secure than trying to experiment with suboptimal or less than 100 room hotels. But I would clarify here that often we look at a cluster of hotels as a portfolio, not just standalone. So if you look at our entire Holiday Inn Express platform, which is about a 1,500 room portfolio, for us, we operate it as one cluster through a shared services center. We would not really operate hotels like a traditional owner, So the ability, the scale that we have, the ability to set up the shared services center often allow us to have relatively smaller hotels in our portfolio than would typically want to, without necessarily losing the efficiency of managing such hotels,
Okay, understood. Now let's talk about financials here. Let's understand basically. Can you help us understand over the last 12 months, the historical ones, which you would have sort of reported? From that perspective, like what has been the sort of average revenue per room which we have been making?
So if you look at the overall portfolio RevPAR, or revenue available per room, and for the broader audience, we like to clarify that the RevPAR excludes F&B income, right? It's basically the room income, but that's the majority of our revenue. The RevPAR actually has grown really strong over the last, I would say, the 4 quarters of FY23. So if you look at the first quarter, which was really just outside of the Omicron, the Omicron was in Jan, Feb, March of 2021, right? So the first quarter was about 3,320 rupees RevPAR. That grew to about 3,400 rupees in the second quarter, to about 3,700 rupees in the third quarter. And we actually closed FY23, the last quarter, RevPAR of 4,326, even though the yearly average, because of the variation between the 4 quarters, was about 3,632 rupees, right? So the annual average RevPAR for FY23 is actually at a reasonable discount to where the last 2 quarters were trending, right? And that's just because the industry was coming out of a recovery stage in COVID, and the first 1 or 2 quarters perhaps were impacted by that.
Now, sir, the important question. The important question here is EBITDA margins very strong, 30% odd. Please correct me if I'm wrong, but 30% plus the EBITDA margins. I was looking at the numbers for you. When I travel to the net profit or net profit margins, help me understand what the sort of difference in terms of performance between the EBITDA margins and the net profit or net profit margins.
So, important question, I think, and let's address it. So, as you rightly said, our EBITDA was about 311 crores for FY23, and we yet had a loss or a PAT loss. Two critical factors there, really. One is a recurring depreciation, which would be there for a business like ours. And the second was really the financing cost. Now, that's the line that we are really addressing through recapitalizing the business. So, as you know, that the total IPO size is 1,200 crores. Majority of those proceeds are going towards deleveraging the balance sheet or reducing the debt on our books. Now, that has two impact. One, the overall debt itself comes down, but also because we are repaying some of the high cost debt, the cost of the debt also comes down. So a combined factor of reduction in debt by a very large primary that we're doing related to our current size, and also the reduction in the cost of financing will really help us kind of reduce the dilution of profits from EBITDA to PAT. Now, as you know, we're not in a position to give you any specific guidance, but the fact is that we're operating in an environment where my whole year EBITDA was 311.5 crores. Having said that, my whole year RevPAR, which was 3632, was at a significant discount to the last 2 quarters. So you can see the trend in the revenues, right? And that trend hopefully will continue. And then a significant reduction in debt by account of the IPO proceeds. I think we are setting the company and its balance sheet on path of profitability, but I think we will resist from giving any specific forecast on that.
No problem, sir. No problem. EBITDA roughly around 300 crores. That was what we were talking about. What was the total gross debt on your books?
The gross debt as in June was 2,850 crores. Net debt. Gross debt will be slight. It includes the cash, but net debt is 2,850 crores.
Sure.
And
the average cost of the debt would be somewhere around 11% because the bank was
average cost of debt was 12.87%. On net debt of 2,833 crores. And as I mentioned, that this will reduce from the IPO proceeds, and this will also impact the average cost of debt.
Sure, sir. How much, now let's do some sort of facts for the viewers. How much funds you are planning to raise from this IPO now? Like, I'm just excluding which you would have raised from the anchor book, but how much funds you're raising now from the IPO?
Okay, so the total IPO size was 1,200 crores of primary, 13.5 million shares being offered for sale. If you look at the breakup of the primary or the total IPO size, the anchor is 616.5 crores. The QIB would be about the balance is about 411 crores, and the HNI and retail portion will be 205 and 137 crores respectively.
Right, and out of 1,200 crores, how much is for reducing the debt?
Majority of that is going towards debt reduction.
Okay, so that actually then is that we are 140 crores of interest cost saving. You were saying something, please say.
Sorry. I was saying that of the 1,200 crores, about 1,100 to 1,150 crores will go towards reduction of debt.
Sure. So that would be roughly about 130 crores of interest savings, and that automatically actually is going to help the sort of profits here. In terms of the sort of net profit levels and net loss levels, just as a repeat information. So what was it the last reported year?
The total FY23 total losses are 366 crores actually.
So even if we do the interest savings, which obviously is very evident it's going to be material, and our viewers actually should take note of that. That's a good chunky improvement. But the remaining part, how do you see basically that turning around for the company?
So actually, if you see during the fiscal year FY23, there were also certain non-recurring finance costs, right? So when you look at the total finance cost of almost 568 crores, right? That obviously includes a fair bit of non-recurring one-time finance cost. So it wouldn't be a simple path of a 140 crore reduction from the existing finance cost, right? It will also include removal of some of the non-recurring finance cost. We had certain convertible instruments, which once you convert, you have to take a one-time cost on that, right? So all of those details are there in the line items are there in the RHP, right?
Sure.
I think it'll be slightly inappropriate to give a specific guidance towards that, but there's a reasonable part of non-recurring finance cost also in the last fiscal. So the way I would construct the path to profitability is one, 311 crores of EBITDA. It is important to mention that the 311 crores of EBITDA was against a REFPAR of 3,600 rupees, that yearly REFPAR. That yearly REFPAR itself is at a discount to where we have seen the last few quarters trending. So that kind of gives us an indication of where the future earnings, revenues, and EBITDAs are headed.
Yes.
Two, significant savings in the interest cost because of reduction in debt and reduction in cost of debt. And then, of course, complete removal of the non-recurring finance cost, right? So there's a fair few levers in play right now here, right? And I think, as I said, we'll resist from giving any specific guidance
No,
or
no.
number here.
Yeah, we're not going to
Adequate,
ask you.
yeah, adequate steps being taken here. But just to clarify, there was a reasonable part of non-recurring finance cost in our P&L last year.
Sure, sir. Last and the most exciting part of always of all interviews is that what are the plans for the next 12 months? I'm not asking you to actually forecast or guide anything, but I'm just saying that as per the usual strategy of the company, are you looking towards sort of an average acquisition of some hotels every year? Like how the strategy is designed?
So, couple of facts to put things in context, right? If you look at the company, it's been created over the last 12 years. The average pace of growth was about circa 295 odd rooms per year, right?
Okay.
When you look at the ACIC acquisition that we concluded in August, that actually gave us about 965 rooms. So the company kind of secured, I would say, if we were to look at historical growth, it secured the next 2-3 years growth through that single acquisition, which has been completed before we came to the markets. In addition to that, like Gyana mentioned, we are adding about 620 rooms to our portfolio. And for this addition, we don't really need to look outwards. All of these assets are on company's balance sheet today, and they will start producing income as we complete them. And there's a different timeline. Calcutta opens sometimes next year. And there's, every few quarters, you'll see inventory opening up. So we will go from 4,800 rooms to 5,400 rooms, just in terms of inventory expansion. And then I will reiterate the fact that in terms of impact on revenue and bottom line, the renovation and rebranding of those 920 rooms is also going to be pretty significant, right? So I think we have a reasonable visibility of immediate growth for the company. And for that, we don't need to really either be dependent on an acquisition or look outwards. All of that is pretty much within the company today when we come to public investors.
Sure, sir. I think that's the point well taken. I think our viewers would be happy to take note of all those points. I would definitely sort of make a special point that thank you for being patient, for answering all our questions in detail. And from all of our viewers, from all of us here, we would like to extend all the best wishes to you for your IPO.
Thank you so much. It was a pleasure speaking to you. Thank you so much.
And with that, dear viewers, we come to the end of this conversation. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.